I didn't know. I knew you were gone.
Use the mic to get people's attention about 30 seconds.
Yeah. That sounds perfect. It's a very intimidating view from Vale.
Okay, get their attention.
All right. Good morning, y'all. My name is Sam Blodgett.
I'm Ankit Kadakia. We're co-presidents of the Energy Club.
You might not, yeah. You might not know there's an energy club at Stern, but there is. And we haven't been very active this year, but we are going to close out with a strong finish. We've got two great events coming up, one tomorrow and one in about 2 weeks. The one event tomorrow is with two founders of solar and renewable energy companies. One is Sungevity, which is the largest privately held solar installer. Great company. They've grown a ton. They're going to talk a lot about the process of founding a company, but also financing and kind of their strategy moving forward. The second is actually a project finance workshop. So those of you that are interested in energy, but also building big infrastructure projects like stadiums or roads, bridges. We're going to do a whole modeling session with Professor Godet and with Professor Wachsberger from the law school, who's going to talk about the process of project finance, which is a pretty exciting, big financial opportunity in the coming years. So both those events are on campus groups. You should check them out. You should also think about joining the Energy Club if you have any interest. Hope that you will hope to see you there.
So there are a few quizzes still waiting to be picked up. And I know you don't feel like picking them up maybe, but they're not going to go away. I mean, I know that this notion of sunk cost is a deeply held one, but it's okay. You can still pick it up and still have a sunk cost. So at least pick them up to check my grading. I mean, if you assume that I'm getting every mistake, actually every right thing right, or I don't even know what I'm trying to say. No. I had a 2.5-hour commute on the train this morning, so I'm completely off balance. Right? But I want to start actually with going back to corporate governance. I know it was way back there. Have you been reading about what's happening at Disney? Somebody fill me in. What's happened at Disney?
The heir apparent to Bob Iger just left the company.
Okay.
Iger was planned to retire next year, I believe, and so it's thrown the succession plan into question as to whether he'll stay around.
Tom Staggs, who was second in line that Bob Iger had supposedly, Jay Rasulo, whose son actually went through, he was in the corporate finance class 3 years ago. That was an interesting class, to have the son of the CFO of Disney in the class. Now, I think I might have burnt a few bridges during that class. But Jay Rasulo was pushed out a year ago. He left when Tom Staggs was elevated to be heir apparent. And now the board has decided, and it's not quite clear what's happening, but he has left, which means that there's actually there's a vacuum right below Bob Iger. Now, I hate to be cynical, but I think this was all triggered by that decision that Bob Iger made in 2000. Remember, he was supposed to leave in 2014? And the board came to him and said, you're too critical, you're too important, you have to stay on. First he said no, then second he said no, and the third he said, of course I am. There are ripple effects you create when you do that. I'll give you an NFL analogy. Any of you Green Bay Packer fans? No? Okay, too far away from the Midwest. Right? But Brett Favre was a great quarterback. And he was getting to be 37, and he was a legendary quarterback. He'd won 2 Super Bowls with the Packers. And there was this guy called Aaron Rodgers who was waiting in the wings. Right? If Brett Favre had said, or the Green Bay Packers had said, you've been such a great, we're going to extend your tenure for 2 more years, Aaron Rodgers would have left. You're saying, what are you trying to say? If when in 2013 Bob Iger made that decision to stay on, there was this effect that rippled through. People didn't even realize how many people had been waiting in line to move up the ranks who now said, it's not going to happen at Disney. I'm going to go elsewhere. Right? It's another reason why I think if you want a transition plan, you have to stick with what you said you were going to do. And my fear is that this entire process has actually been orchestrated by Bob Iger in the background. Because 2017 comes around, there's a vacuum. You see what the board's going to do, right? They're going to go to Iger and say, this time you absolutely have to be there, because now there's nobody below you. And that's a scary place to be, is if you've made a CEO so critical that nobody wants to be next in line. There is a rumor, and this might be entirely rumor, that the board actually has somebody else in mind from the outside. In fact, the person that they have from the outside is actually on the board right now. You know who they're thinking about? High profile. Sheryl Sandberg. In fact, I think there is a rumor that that is what the plan is, that they want somebody who has, and that might happen, it might not, but I think it'd be interesting. It actually is great for me, because this is like a lab experiment that keeps on giving to me. Right? And that's a nice thing about almost every company, including the companies you analyze, is there's constantly stuff happening that changes the way you analyze the company. So let's pick up where we left off. You were a little distracted after the quiz, and I have to apologize. Can you get his attention right behind him? I have to apologize too, because I was, when he said that people didn't have time, I almost bit his head off. And then I looked at your quizzes, and I discovered that the 2/3 of you who were struggling at the end really did have a time issue, which is as much on me as it was on you, because I think I left too many moving pieces in the quiz, so I think that's partly it. But I think that you were a little distracted after the quiz because you felt kind of brain blown, that's the right word. But during the last part of that session, we talked about using the cost of capital to come up with the right mix of debt and equity for the company. And let me review very quickly what we did. We said we're going to look for that mix of debt and equity at which your cost of capital is minimized. Think of what? If you minimize your cost of capital, you maximize your value as a business, and we said that's your right mix. And then we went into the mechanics. To get the cost of capital at every debt ratio between 0 and 90%, I need a cost of equity at every debt ratio and a cost of debt at every debt ratio. The cost of equity, we said, should be simple. Why? Because if you have the unlevered beta for a company, you can tell me what the levered beta will be at 10%, 20%, 30%. So the cost of equity will rise, and I can tell you exactly how it's going to go up. The cost of debt was a little messier. Intuitively, what we were trying to do is compute the interest coverage ratio that you would have as your debt ratio went up, and use that interest coverage ratio to come up with a rating and an interest rate. But there was that circular logic problem we ran into. To get the interest expense, you need the interest rate. And I went through that process with 30% debt to show how to do it with that, with iteration, second, third iteration. This is the final picture that I got with the iterations at every debt ratio. So let me go through this table. As my debt ratio goes from 0 to 90%, my dollar debt climbs proportionately. Why? Because I'm taking 10%, 20%, 30% of that same $137,984 million, the total value of the company. I'm raising the debt ratio. As my dollar debt goes up, my interest expense goes up more than proportionately. Why? As my debt ratio, so as my dollar debt goes up, the dollar debt goes up in fixed increments. Why is my interest expense going up more than proportionately? Because my interest rates go up. The rate at which I can borrow money at 10% is lower than the rate. So as my interest rate goes up, so you have two effects. I have more debt, and the interest rate I pay on the debt goes up, so my interest expense goes up. As my interest expense goes up more than proportionally, my coverage ratio drops off, because I'm keeping, remember I kept the EBITDA and the EBIT fixed. So because my operating income stays fixed and my interest expense goes up, my coverage ratio decreases. As my coverage ratio decreases, my rating, which starts at AAA, ends up at single C. As my rating decreases, the interest rate I will have to pay on my debt keeps climbing and climbing and climbing, from 3.15%, which is the AAA rate, to 13.25%. There's one final loose end here that I want to deal with. The way we get after-tax cost of debt was we take the pre-tax cost of debt and we multiply by 1 minus the tax rate, right? Up till this point in this class, I've used a 36.1% tax rate for Disney, and I leave it at that number when I change my debt ratio. But if you look at that second to last column, notice my tax rate stays at 36.1% up to 60%, and once I get past 60%, it starts dropping. First, is this a good thing or a bad thing? When you're computing after-tax cost of debt, is it a good thing or a bad thing to have a lower tax rate? It's a bad thing because it makes you after-tax. So what exactly do you think is happening at a 70% debt ratio that's leading me to lose tax benefits? How do interest expenses work to save you taxes? What do you have to have? You have to have income. The IRS doesn't mail you at 36.1% of your interest expense as a check. You have to have income that you can use to offset the interest expenses against. So you see what's going to happen at what do you think is happening at 70% debt then? The interest expense I have becomes so high that I don't have enough income to cover the interest expense. In fact, let me take you through the mechanics of exactly what happens at the 60 and the 70 so you can see what the break is. At a 60% debt ratio, my EBIT is going to be 10,032 million no matter what. That's your operating income. But at a 60% debt ratio, my interest expense is 9.5 billion. A lot of interest expenses, but still lower than the 10.032 billion. So dollar for dollar, I get the 36% tax benefit. So at 60, I'm okay. At a 70% debt ratio, my interest expense actually climbs to $11.1 billion. My taxable income is only 10,032 million. So I'm going to be allowed to deduct up to 10,032 million, and then I have to stop. So I take 10,032 million times 36.1%. That is the cap on my tax benefit. I cannot get any more tax benefits. So my tax benefits stay at 3,622 million. My interest expense keeps climbing. So if I divide the 3,622 million by this higher interest expense now, my tax benefit decreases to less than 32.64%. Do you see what's going to happen at 80%? When I go to 80%, I'm still capped at the 10,032 million. So my tax savings gets capped at 3,622 million, but my interest expense keeps climbing, which means that if you look at 80 and 90% debt, my tax benefits get smaller and smaller. Now this might sound conservative to you, because if I have losses, I can carry them forward. You're saying, why can't I get... Because this is not a temporary problem where you had a bad year. You just borrowed way too much. I cannot give you the benefit of future tax savings on the assumption that your income will rise to cover your taxes. It's a problem I see in LBOs all the time. People who do LBOs will often take the debt, act like they get the entire tax savings on the debt in perpetuity. And my response is, are you sure this is going to happen? Because you borrowed so much money that you could very well run into the problem of not having enough income to cover those interest expenses. You need the income to get the tax benefits, and this kind of caps it at whatever that 10,032 million is. Any questions? So I've got my cost of equity. I've got my after-tax cost of debt. Here's my, remember that XYZ widget company I started this process with? This is my Disney table for the optimal debt ratio for Disney. So there's my debt ratio going from 0 to 90%. I didn't go to the 100 because, as I said, that's unrealistic. The beta goes from 0.9239 to 7.41. Why? Because it's a levered beta. And as I borrow more, my beta increases. As my beta increases, my cost of equity goes up from 8.07% to almost 45%. My cost of debt after taxes starts at 2.01% because I give them that AAA rating. But then as I borrow more money, that cost of debt rises to 10.33%. The cost of debt rises for two reasons. Initially because the ratings decrease, but then once I get to 70, 80, and 90%, also because I lose tax benefits. There's my after-tax cost of debt. I take a weighted average. I've got my cost of capital in the last column. What's the objective again? The right mix of debt and equity is the one that minimizes my cost of capital, right? So based on that criterion, what's the optimal debt ratio for Disney? 40%. That's a little unfortunate that we've had two examples in a row where I got 40%. And a few months ago, I was actually doing this at an investment bank, and I won't name the bank. It was actually a re-education program for corporate bankers, to remind them of things they shouldn't forget. And there were a couple of people in that room who did not want to be there, but were forced to be there, and they made it very obvious. So there's one guy who sat in the last row with the Wall Street Journal opened up in front of him for 2 days. My only thing was he never turned the page. I said, how long does it take you to read one page? At least act like you're reading the paper. Don't just, And then I did this, and he put up his hand and said, finally, the guy's going to ask a question. So I said, what's your question? He said, can we safely assume that the optimal debt ratio for all companies is 40%? Hey, investment bankers always looking for a rule of thumb, 40%, right? And I said, you can safely assume whatever you want, and I will safely assume you will not have a job in 6 months. And my assumption was better than his assumption. Right? So let me put this on the table. You cannot safely assume that the optimal debt ratio for all companies is 40%. You know how we'll find out? Because each of you has to do this on your project. And in the last day of class, I'm going to show you the distribution of optimal debt ratios you're going to get across the 331 companies in this class. And they'll range from 0%, there'll be some companies with the optimal debt ratio is going to be no debt, to as high as 70 or 80%. And we'll talk about what causes those differences across companies, but this is just pure coincidence that we got 40% twice in a row. In fact, if I showed this to you as a graph, remember that classic cost of capital graph you see in every corporate finance book? This is my version of the graph, but it doesn't quite look like a U, right? In traditional textbooks, it's always a U. Initially, as I borrow money, my cost of capital does decrease. But notice that there's an inflection point. You see what I mean by inflection point? It drops a little, and then at 40%, it suddenly takes off. That's the way, in my experience, costs of capital behave at real companies. And if you're a company, you want to avoid those inflection points like crazy, because once you get into that it's like a vicious cycle. You get into trouble, it creates even more trouble. Think of where Valiant is right now. That's exactly where you don't want to be. So when you make your decision on how much should I borrow, you want to look not just at where the cost of capital is minimized, but what happens afterwards. So when I look at Disney, I know the optimal is 40%, but there's also a red light going on saying, hey, if you can say at 35 or 34, you're probably better off than going all the way to 40, because if you go to 40 and something goes wrong, then all heck can break loose. Any questions on the cost of capital? So this is the 4th edition of this book. So I have this cost of capital graph in 97, 2002, 2007, 2013. So I'm going to show you what the cost of capital graph looked like in 1997. So I did exactly what I did now in 97. The optimal debt ratio then was also 40%. This is getting to be a pattern. Maybe this guy was right after all. But notice something about this graph that's a little disquieting. So initially, as you borrow money, cost of capital decreases. I also did a classic statistical cheat. Do you see why it looks like it decreases more than in the previous page? Look at how I've scaled it's a classic way in which you can make small changes look like big changes. Use it when you have to. Right? So don't feel any qualms. Let the other guy, if he's not familiar enough with statistics to ask you that question, he deserves to be taken to the cleaners. This is basic, right? You look at a graph, the first thing you check is what's the y-axis. Then as you borrow money, the cost of capital starts to go up from 40 to 60, and then something strange seems to happen. There's a kink. It's a kinky cost of capital graph. The Excel spreadsheet that I'm going to send you with after class today will do this for you. And it's been on my website now for 25 years. I've added bells and whistles to it, but the basic spreadsheet has been on since the 1990s. And people have downloaded it and used it for whatever purposes. And there was a group at what was then, First Chicago Bank, which became part of JP Morgan at some point in time in the 1990s, who were downloading the spreadsheet. These were corporate bankers downloading the spreadsheet and using it for their clients when they were doing optimal debt ratios. I learned about it. I really didn't care. So one day I come back from class, the phone rings, I pick it up. It's a First Chicago banker on the phone. He said, I'm calling from a restroom. Yeah. Days before cell phones, maybe there's a call phone. So I said, okay. Yeah. Something very embarrassing has happened. He's calling from a restroom, something very I said, call your mother, don't call me. This is not my problem. He said, no, not that kind of embarrassing. I'm in the middle of a client presentation. I've used your cost of capital spreadsheet to come up with the optimal debt ratio and shown the graph. There's a kink in the cost of capital graph. My client wants to know why there's a kink. What's wrong with your spreadsheet? It takes a lot of gumption to download a spreadsheet for free, use it for commercial purposes, and then turn around and say, what's wrong with your spreadsheet? I had this guy over a barrel at that point in time. I could have asked him for his last 3 years of tax returns, his bank account number. I was in a good mood and I told him. And you can probably tell him why there's a kink. Think about the process by which we estimated cost of capital. There are only two moving parts, right? There's a cost of equity and a cost of debt. I'll give you a clue. Whenever you get something like this happening, it's because one of those two numbers is moving discontinuously. See, what are you talking about? First, take me through the cost of equity process. What do I do? Every time the debt ratio changes, I compute a levered beta, right? So even if my debt ratio changes by a small bit, my cost of equity, so the cost of equity is continuous. But how do I get the cost of debt? I start with an interest coverage ratio, then I go to the you see what's going to happen. Lookup table, I look up the rating, I come up with the interest rate, I use it as my cost of debt. You see what could happen? I could borrow a lot more money, but if I end up staying in the same row in the ratings table, I could tell you you're still BBB rated even though you have $10 billion. You see, that's so unrealistic. In the market, you can have high BBB rated and low BBB rated, but because I'm attaching one cost of debt to all of the BBB rated bonds, I said that's what's happening. Your cost of debt is moving discontinuously because I'm going to the ratings table and I'm getting this jump. So what's happening is as you go from 60 to 70% debt, that's 10% more, your rating did not change, which is unrealistic. So it made your cost of capital look like it was going lower. But then when you went from 70 to 80, it changed a lot. So you sort of, he said, how do I make it go away? So I gave him two suggestions. The first is I said that ratings lookup table that you have is a completely artificial one. It's a hypothetical table. Break it down into smaller bits. He said, what are you talking about? I said, why don't you make it BBB+++, BBB+++. In other words, the smaller you make the notches, the less likely it is you're going to have this problem. He said, that sounds like too much work. I said, okay, I'll give you a second suggestion. Why do I even look up a rating? Because I want a new cost of debt, right? What if I could just directly connect the interest coverage ratio to a cost of debt, where instead of having to go through this intermediate phases of looking up a rating, I had an equation that said, you tell me your interest coverage ratio, this is what your cost of debt could be. He said, that sounds too complicated. I said, okay. What's your optimal debt ratio right now? He said, about 20%. I said, where's your kink? At 60%. I said, what will happen to your optimal if the kink goes away? He said, it'll still be 20%. So I said, why are you so obsessed with making the kink go away? It's a cosmetic problem right now. Your real issue would be if you had a kink at the optimal, which almost never happens. What I'm trying to prepare you for and save myself some emails is that week before the project is due, which is when you're going to be doing all of that stuff. I'm a realist on this. I keep nagging, but I know it'll never happen. So it'll be the Friday before the Sunday when the project is due. You're going to run the cost of capital graph. You're going to get a kink in the cost of capital graph. And unlike this guy who called me, you're going to email me saying there's something wrong with your spreadsheet, there's a kink. And I'm preparing you for the answer you already have, but you'd have forgotten by then. But I will give it to you again. It's happening because the cost of debt is moving discontinuously. And it's not a big deal if it's not affecting your optimal. So now let's complete the process. So I have an optimal debt ratio for Disney of 40%. Their existing debt ratio is about 14% or 15%. I'm sorry, maybe 16%. So I'm telling them they have huge debt capacity. Right now they have about $16 billion in debt, and based on my analysis, I'm saying they should have $55 billion in debt. So I'm telling them they can go out and borrow $39 billion. And I'm going further. What am I saying they should do with the $39 billion? What do we assume happens to the debt that comes in? That it goes out of the other window. So not only am I telling them that they have $39 billion in debt capacity, but that they should borrow $39 billion and buy back stock or pay dividends. That's a pretty big action, right? So if they have any sense, they should have 3 questions they should ask me. And these are 3 almost standard questions you're going to run into any time you do this for a company and you tell them you have debt capacity. The first question you're going to get asked is, why should we do it? You think the answer is obvious. Your cost of capital will go down. You're going to see very quickly why that pitch doesn't work very well. The cost of capital change is going to be so small that people are going to look and say, that doesn't sound like much. So I have to make it real money. Second, and this is a legitimate question, anytime you borrow money, you have to ask, what if something goes wrong? Like what? What if I have a recession? What if there's something wrong with one of my theme parks? What if there's an expense I never expected show up on my financials? What if something goes wrong? And third, let's assume that Disney has big plans. And it does, right? It wanted to build that Shanghai theme park. It wants to make the next Star Wars movie. This sounds like a silly thing to do, borrow $39 billion and buy back stock, and then have to go raise money to take all these new investments. So the third question you might get asked is, what if instead of buying back stock and paying dividends, we took projects instead? Would that still work? Would the optimal still be 40%? So I'm going to take each of those questions, and it's not so much about Disney that I want to make this about, but to give you a kind of generic way of answering why should we do it, what if something goes wrong, and what if I don't want to buy back stock. So let's start with the first question. Why should we do it? Hey, your cost of capital will go down. In fact, your cost of capital before was 7.81%. That was the old cost of capital. If I go to the optimal, and I'll show you the page, at a 40% debt ratio, my optimal drops to 7.16%. So right now they're closer to 10% than to 40%. So if they go from 10 to 40%, the cost of capital will go from 7.81 to 7.16%. Now think about it. That's about what, a 0.65 change in the cost of capital. And your first reaction is, that doesn't sound like much. You want me to borrow $39 billion and buy back stock to get a 0.65% drop in the cost of capital? So let me try to convert that into real money. 65 basis points, 0.65% doesn't sound like real money. Let's talk about what will happen if in fact you do this. Remember what I said, the cost of capital is the discount rate I used to value the entire company. So what I'm actually going to do is I'm actually going to take Disney as a company. So this is a little unfair because I'm jumping 10 sessions ahead to doing a valuation of the company, but I'll keep it simple. I'm going to get the cash flow for the entire company, and I estimate cash flow exactly the same way I did for the Disney theme park. I take the after-tax operating income for the entire company, I subtract out capex, I add depreciation, I subtract out change in working capital. It's the exact same 3 line items. I end up with a cash flow for the entire company of $3.657 billion. So that's my cash flow. Right now their cost of capital is 7.81%, right? Let's keep this simple. Let's assume that Disney is a stable company, stable growth company that can grow at a constant rate forever. Remember the growing perpetuity formula? Well, after the second quiz, you should, right? 3B, you needed that. Growing perpetuity formula, you need the cash flow 1 year out divided by the cost of capital minus the growth rate. Here's what I'm going to do. I'm going to take the existing value of the firm, which is $133.9 billion. That comes from adding the market value of equity to the debt and netting out cash. This is what the market is valuing Disney at, and saying, let's assume it's right. You're saying, why assume it's right? Later in valuation, we'll come back and ask, is it right? In this part of the process, I want to start with that 133.9 billion and back out from that 133.9 billion what growth rate the market is assuming. This is called an imputed growth rate. Basically what I'm doing is I'm taking the market price, saying I know the price, I know the cash flow, I know the cost of capital. What growth rate will I need to get the value? The growth rate I end up with is about 4.94%. That's already a red flag. 4.94% is too high a growth rate to maintain perpetuity. You're saying, how do you know? The risk-free rate I'm using in my analysis is only 2.75%. But I decide to go ahead anyway. In a minute, I'll talk about what I would do instead. But if I decide to go ahead anyway, here's what it will look like. My cash flow doesn't change because it's a pre-debt cash flow. My growth rate doesn't change because I still have the same projects. But if I go to my optimal, my cost of capital will go from 7.81 down to 7.16%. So I have exactly the same numbers as before, but I now replace the higher discount rate with the lower one. My value jumps from 133.9 billion to 172 billion. I get an increase in value of almost $39 billion. Remember you said 65 basis points didn't sound like much? What about $39 billion? That sounds like a lot, right? So if I'm going to sell you on moving to the lower cost of capital, I'm never going to say 65 basis points. It's kind of meaningless. I'm going to say 39 billion. But remember the caveat I added. I'm pushing my luck here by leaving the growth rate at 4.94%. And this does require that you value the entire company. So I'm going to give you my second way. And this is the way I prefer to do this because it keeps my analysis under control. One way to think about the cost of capital is it's what it's costing you to fund this entire company today. So when I say your cost of capital is 10%, that's like saying today when you fund the company, you need to make 10% of your value to clear your cost of capital. So here's what I did. I looked at the cost of funding Disney at the old cost of capital at 7.81%, and I came up with 10,458 million. And then I looked at financing Disney at the new cost of capital, the lower cost of capital. I came up with 9,592 million. So by going to the lower cost of capital, my annual cost of funding this company has dropped by about 866 million. So it's like a savings each year. My value as a company should increase by the present value of those savings in perpetuity. And here I'm going to follow that growth rule, which is I don't want the growth rate to be too high forever. So I'm going to leave the growth rate at the risk-free rate, 2.75%, but I'm going to use the new cost of capital. And what I get as an increase in value is almost $20 billion. This is like magic. It's the same company, same assets, same projects. All I've done is change the mix of debt and equity. And magically, $19.6 billion in additional value showed up. So I have a question. Where's all this value coming from? I've never believed in alchemy. The alchemy is the old thing of converting everything into gold. I've never believed in it. So the value has to come from somewhere. Where is this additional value coming from in this process? It's coming from one place and one place alone. What's the biggest benefit of debt? It's tax benefit. You know what I've just done? I've just transferred $19.6 billion in value from taxpayers to Disney. I'm not taking fault with Disney for doing it. It is exactly the way the tax code is written, but any time you get an increase in value from a leveraged transaction, it's not coming from better projects or creating higher value from your projects. It's coming from the tax benefits of debt. And that's what I think we need to think about. Over the last 30 years, as in the US, an increasing proportion of value created, and I'm going to put quotes around the value created, has come from what's called financial engineering. Financial engineering basically is changing leverage, right? That's just a fancy word for it. What you've essentially done is not created value for the economy, you've just moved value around. That might reflect the fact you're a mature economy, but I sometimes get on these panels with LBO guys who like to get up and talk about how much value they've created, and I feel like stopping them in the middle of the discussion and saying, stop talking nonsense. You've created value for your stockholders, but you've just transferred that value from somewhere else. Unless you change the operating base of the company, you're taking better projects and you're creating higher cash flows, it's really not creating value for the economy. Again, I'm not faulting Disney for doing this if they do it. I'm just saying that when all of your value creation or most of it comes from playing the leverage game, the economy can't benefit from that because all you've done is moved wealth around in that economy. Any questions? So let's make this practical. Let's suppose that you make this presentation to Disney's board and they say, okay, 19 billion is a lot of money, or almost 20 billion, 19.6 billion. Let's do it. Do what? Go out and borrow 39 billion and buy back shares. So you be my investment banker and I'm going to come to you for some advice. Right? I'm Disney. I've decided to borrow 39 billion and buy back shares. So how's this going to work? You know, what's a practice? So if I want to buy back $39 billion of shares and I want to do it quickly, what's the process by which I do it? Can I do it a little at the market every day, come in and slip in and slide out and buy 100,000? If I do this, the SEC actually specifically forbids you from doing it because that's viewed as price manipulation. If you're going to buy $39 billion worth of stock quickly, there's only one way to do it. You have to do a tender offer. Usually you hear about tender offers in the context of an M&A or an acquisition. Here you're going to take a full-page ad in the Wall Street Journal as Disney and say, if you're a Disney shareholder, tender your share back to us and we'll pay you X dollars. Right? So your job as an investment banker is to give me some advice on what that X dollars should be. Let me set it up. The stock price before this transaction at the old debt ratio was $67.71. Can I make a tender offer at $67.71? I could, but who's going to tender, right? Because they're not going to tender at the old price. They can sell at the regular market. Why? So if I'm making a tender offer, almost by definition, I have to offer a premium on the price. So this is a practical question that everybody who makes a tender offer face. How much should that premium be? So let's play a game in this case. Let's assume that you guys be the investment bank still. You guys be the shareholders in Disney who are going to continue to hold the shares after the tender offer. So you're not tendering your shares. And you guys are going to be the folks who tender your shares back. So these are all the Disney stockholders right now. But those shareholders are going to stay in the company. You're going to tender back. If this is a fair price that I pay on the tender offer, you know what should be true? Everybody should get about the same share of that 19.6 billion. Do you see why that is? Because if this is a fair transaction, the people who sell their shares back and the people who don't should almost be indifferent between doing it and not doing it. So here's the first thing I'm going to do. I'm going to assume that this is a fair buyback. Most buybacks are not fair, and I'm going to explain why. But if this were a fair buyback, the price I pay on the tender offer should be such that everybody gets an equal share of 19.6 billion. That actually makes my life incredibly simple, because here's what I'm going to do. I'm going to take the 19.6 billion that I got on the previous page and divide by the 1.8 billion shares outstanding before the buyback. Everybody gets the same share. I get a price of $78.61. In a couple of minutes, I'm going to show you, I'm going to prove to you that it's a fair price. But if I pay $78.61, here's what's going to happen. You guys obviously are going to get $78.61 in cash. But after the transaction, your shares will be worth $78.61 as well, because I've divided those spoils equally among the stockholders. That's a fair price. But you're the investment banker, right? You want your life to be easy. That's natural. It's human nature. So when you set up this tender offer, you want to set a price which will make your life easy. Which is going to be? To push the price up. And if you pay $85 or $90 in the tender offer, you're going to get the tender offer done really fast, but then you guys are going to get a bigger chunk of the spoils, and you who are the long-suffering, loyal shareholders will get a smaller share of the spoils. So if I pay a price higher than $78.61, they'll gain, you lose. But let's say that I could pull off a different trick. Let's assume that I could buy the shares back at the old price. That would be almost magical, but let's say I could do it. If I could buy the shares back at the old price, then you are obviously getting almost nothing. In fact, you're getting nothing of the 19.6 billion, and all of it is going to come to you. So the 7861 becomes almost a magic number. By looking at that, I can tell whether the people who are selling back their shares gain or the people who are remaining in the company gain. So here's the general way in which to approach any time you have a buyback, and this is not just the Disney buyback. If your value is going to increase because you're going to go out and borrow money, the first thing you're going to do is take the debt you're going to borrow, the 39 billion, and divide by the number of divide by the share price you have to pay on the buyback, because that's going to tell you how many shares you will buy back. Those shares are now going to be put in a bonfire, burnt, they're gone. The shares left after the buyback will be whatever the shares are now minus those shares you bought back. So I'm going to take the remaining value of the company and divide it by the remaining shares. So let's try a couple of prices so you can see exactly what I mean. Let's start by taking that very unrealistic scenario where I was able to buy the shares back at the old price, 67.71. The amount I'm going to borrow is 39.175 billion. If I buy back shares at 67.71, I'm going to end up buying back 1,221 million shares in the buyback. I'm sorry, I'm going to end up buying back 579. I'm going to end up with 1.221 billion shares after the buyback. So that's the number of shares after the buyback. If you look at what the value of the company is after the buyback with the higher value that I get from the lower cost of capital, the value that I get is 102 billion, which effectively means that with the remaining shares, you guys will end up with almost an $84 per share stock price instead of 78.71. Why? Because I bought the shares back at the existing price. So if I buy the shares back at less than 78.61, and best of all at the old price, the remaining shareholders will end up as winners because they now get to keep the entire 19.6 billion. If I buy back at exactly 78.71, 78.61, let me show you why this works out as an even exchange. At 78.61, if I buy back shares, I end up with 1.3 billion shares after the buyback. I take the value of the firm post buyback and divide by 1. I end up with a price of 78.61. So you end up with a price of 78.61. You get paid 78.61. Everybody walks away with exactly the same value. I want you to try a what if after class today, and it's going to take only 5 minutes, but it'll kind of cement this. I want you to tell me what will happen to the shares of the remaining shares in the company, the price of those shares, if you bought back the shares at 84. So I've showed you 67.71. I've showed you 78.61. I want you to try $84. Because with $84, I know exactly what you guys are going to get. You're going to get 84. But those guys are going to get less than 78.61. The question is how much less? Now do you see why buyback prices matter? Berkshire Hathaway, for the longest time, Warren Buffett did not do buybacks, but about 3 years ago, he announced his first stock buyback. Huge opening in the dam, because until then he said, always pay dividends, never buy back shares. But it came with a caveat that you don't see in most buybacks. The buyback at Berkshire Hathaway was conditional on the price being less than a certain amount. In other words, he had a price. He's a big believer in book value, because in Berkshire Hathaway, book value is marked to market. So if he says the book value is more than a certain number, the stock is overvalued. So the buyback, which I actually said, the trigger price was the price fell to below 110% of the book value, then the buyback would kick in. If the price was higher, there would be no buyback. In other words, he set a trigger price. And if I were to set a trigger price in the Disney case, the trigger price would be 78.61. If the price is higher than 78.61, I don't want you buying back shares, because you're punishing the wrong people. You're punishing the people who stay on in the company. And that's, I think, something that we increasingly have to start adding to buybacks. I mean, because let's face it, and when you get to the dividends, you're going to see this. Last year alone, US companies bought back $550 billion worth of stock. That by itself is neither here nor there. So, that's how you return cash. But over the last 20 years, when you look at when companies buy back shares, if you're thinking logically, when should companies buy back shares? When the price is low, you buy back shares. In the US, buybacks actually peak when the stock price is highest. and they become lowest when the stock price is lowest. So that's actually one of the things that people, now one of the arguments used against buybacks is, if people are timing markets, they're doing it awfully, but I don't even think they are. The process by which we do buybacks doesn't even look at the buyback price seriously enough, and I think we need to do that to make sure that we're not punishing the wrong people by buying back shares at too high a price. Any questions? Now let's look at the second question. What if something goes wrong? If you're ever asked this question, the one answer you should never give is, nothing will go wrong. Because it's almost like tempting fate right there. As you walk out of there, terrible things are going to happen to this company. Of course something can go wrong. Whenever I'm asked this question, I always turn the question back on the person asking the question and say, hey, tell me, what is it that you're worried that can go wrong? Because the answer is going to be different for different companies. If you're a defense contractor, you say, what if something goes wrong? You're worried about the next year's defense budget, you're going to be out of the budget. If you're a manufacturer who gets 50% of your revenues from Walmart, what are you worried about? That contract will leave you. If you're a commodity company, and you ask me, what if something goes wrong? What are you worried about? That oil prices will drop, iron ore prices will drop. With each company, there's always something that is in the background, and you got to bring it to the foreground. You got to deal with it. Because it's silly to advise people to borrow money, say, don't worry about the consequences, and walk out and have them go bankrupt 2 years later. This is not just about increasing value for the next year. It's about increasing your value in the long term. That's what change in value we computed. So I'm going to go through two ways in which you can deal with this what if question. The first is to take whatever you're worried about, bring it into the operating income. This is very much an income-driven approach to how much can you borrow. Income-driven approach, how? Because that operating income drives your interest coverage ratio and your cost of debt. So if you don't have the income, I'm going to tell you not to borrow money. And I'm going to take that operating income and say, if something bad happens, what will happen to that operating income? So I'm going to do a what-if analysis around the operating income. What if it drops 10%, 20%, 30%, 40%? See how sensitive your optimal is to those changes. I'm also, if I can, specifically going to take whatever you're worried about. You lose that contract with Walmart, what will happen to your operating income? Put that in and see what the optimal is going to be. So I'm going to make sure that you have enough buffer when you borrow money. The second thing I can do is use that synthetic rating. What did I say the objective in cost of capital is? Minimize the cost of capital, right? But I never mentioned rating. So your cost of capital could be minimized where your rating is double B or single B. There's nothing in the process that constrains what your rating can be. And that sounds a little dangerous, right? So I'm going to ask you, what's your minimum rating? Do you want to be triple B, single A? We'll talk about ratings constraints and how they might stop you from going all the way to the optimal. So let's try these both for Disney. Let's start with the what if by looking at the operating income. So the question I had to ask for Disney is, what does a bad year look like for Disney? You think that's a silly question. A bad year, their operating income is going to drop. By how much? Because there are some businesses where a bad year could be a minus 5% drop. If you look at a regulated utility, for instance, your operating income doesn't drop by 50%. It might drop by 5 or 7 or 8. If you're a technology company, it could be 50%. So for Disney, the only way I could answer the question is by going back in time all the way to 87 and looking at what each year delivered as a change in operating income. So look across time, and you can see the worst year Disney ever had in this period was 2000, where their operating income dropped by almost 30%. That was a really bad year for Disney. In fact, that's the worst year in this process. If you just look at the standard deviation in operating income across this 25-year period, it's about 19%. So I'm kind of filing away these things as I'm going along. A bad year was 29%, a standard deviation of 19%. I also looked at recessions over time. So if you look at the 81-82 recession, Disney's operating income actually increased during that period. So the recession didn't even seem to hurt them. 91, it dropped 22%. 2002, dropped 16%. 2009, it dropped 23%. So I'm getting a measure of what a bad year looks like for Disney. A bad year probably is what, a 20 to 25% drop in operating income. Here's what I did next. I dropped the operating income by 10, 20, 30, 40 to see what happens to my optimal. Remember my optimal was 40% unconstrained? When I drop the operating income by 10%, it stays at 40%. 20%, it stays at 40%. What am I finding out when I do this? I'm finding that Disney has enough buffer built into the process that even if they go to 40% and have a really bad year, they're going to be okay. Will this always be the case? When you do this for your company, let's say you have a technology company and you find a typical bad year is a 40% drop in operating income. And you start changing your operating income and small changes make your optimal go from 30 to 10%. That should be a flag. That should be something you build into your decision process saying, not enough buffer here, I'm not going to go to 40%. In this case, after I did this, I felt pretty comfortable with the 40%. When I say 40%, I'm saying around 40. If you end at 37 or 36, I'm perfectly okay with it. Yes?
If something like a recession happens, does the rating agency change their thresholds because every company will be affected?
Not necessarily, because they use, that's why in boom years you don't get as high a rating. If you remember, Disney's rating in 2013 was a single A, even though their interest coverage ratio was, should have given them a double A rating. Because what ratings agencies do is they look at normalized income across time, an average income across time, until they get a structural break. What's a structural break? With oil companies, ratings agencies don't know what to do now. Because for a couple of years they assumed that things would revert back to a $65 oil price and that everything would be okay. But the longer prices stay around 35, the more the ratings agencies have to go back. So I wouldn't be surprised in the next 2 years you saw a lot of downgrades of oil companies if oil prices don't bounce back up. But they do try to normalize things because they don't want to be a rating that kind of jumps around just because you have an economy in a recession or a recovery. Any other questions? So that's the first way to do it, is just play with the operating income and see how much give you have in this company. Let's look at the second. As I said, in a typical standard approach to the cost of capital, you just go to the optimum. You don't worry about your rating. You just do whatever minimizes your cost of capital. But in almost every company I've ever worked with in this process, there's a rating constraint. What do I mean by that? There's a certain rating below which they don't want to drop. In the US, what's that typical threshold you hear about for companies? What do they not want to drop below? What's the rating? Triple B, which is called investment grade. I ask you, what's the big deal about triple B? What happens if you fall below investment grade? What? So what if you're a junk bond? Just name that they give you a bond. Your cost of financing went up from single A to triple B as well. It goes from triple B to double B plus. That's not unusual. It jumps even more. So now you have to add something to your story, which means your access to capital, bond markets, becomes much less if you're a double B than a triple B. Is that true? It used to be categorical. Pre-1980, it was absolute. If you were below investment grade, you could not issue bonds. Until Mike Milken and Drexel Burnham changed the rules of the game. What did they create? They created a high yield bond market has always existed, but pre-1980 you got to be a junk bond because you started investment grade and you slid. What Mike Milken and Drexel Burnham created was an original issue junk bond market where even if you were double B, you could issue bonds and people would buy them at a high enough rate. So it's not as difficult or impossible as it used to be, but there's still that tipping point where you go from triple B to double B. There is that added capital constraint which will make your cost of debt jump a little more than it did from single A to triple B. What else happens? The day that your rating drops, what does the Wall Street Journal run a story of? That your rating has dropped. And so what? Who's reading that story? Everybody in interest in your company. Your customers are reading it. And then what do? They stop buying your product. Your suppliers are reading it. And you get that call saying, cash from now on, people put big stacks of currency outside your front door. Your employees are reading it, and it's not exactly uplifting news, right? Remember that indirect bankruptcy cost we talked about? You worry about that getting triggered. And if you're a company that doesn't care, you're a grocery store, you might say, I don't care. But if you're a manufacturing company or a company that cares about long-term contracts, you make durable goods. Yeah. So I can understand investment grade constraint, and I can even understand some buffer. You say, I don't want to be triple B because that's too close. I want to be single A just to give myself some buffer. But once in a while, you will run into a company which is an absolutely unrealistic ratings constraint. Like what? I still remember talking to the CEO of a steel company in Europe. This was way back in time. And he was the last AAA rated steel company in the world. So I asked him, What's this big deal you make? The whole company, this was a fixation. You can't lose your AAA rating. So I asked him what this fixation with the AAA rating was. And he said, it's because we can borrow money at a really low rate. So then I asked him how he maintained this AAA rating. And he told me. He said, we never borrow money. This is the kind of circular logic that gets companies in trouble. So you want to maintain the capacity to borrow money at a really low rate, but the only way you have that capacity if you never borrow money, maybe you should try going to AA and actually borrowing some money. Maybe that'll actually get you a benefit. So if you're given a AAA ratings constraint or a AA or a single A, one thing you can do is actually cost out the constraint. You're saying, why should there be a cost? This is like constraint optimization, right? In the first approach, I just said optimize. Just go to the lowest cost of capital. Now I've added a constraint to the process. We know mathematically, any time you add a constraint, you've got to pay for it. Now you have to decide whether what you're paying is a reasonable price. So I'm going to price out the constraint. It's actually very simple to do. In the case of Disney, at the optimal debt ratio of 40%, I actually gave them a synthetic rating of single A. So if they're okay with the single A rating, we're done. But let's say the manager of Disney say, we want a AA rating. Here's all I need to do. Go back to the table, see what the highest debt ratio I can get to, where I can maintain my AA rating is and lower my cost of capital. And that happens to be a 30% debt ratio rather than a 40. And the difference in values between the unconstrained optimal, which is the 40% debt ratio, and the constrained optimal, which is the 30%, is about $5.7 billion. I'm going to give you the bill. So you want a AA rating? It's going to cost you $5.7 billion. You say, that's okay? Okay. It's your stockholders. I was going to say it's your money. It's really not. It's your stockholders' money. If you can get in front of them and say, this is what we're paying for a AA rating, okay, that's fine. If they say we want a AAA rating, the most they can borrow is 20%, and the cost of the ratings constraint went up to $12 billion. If I had some time with the CEO of that steel company, I'd have said, congratulations on your AAA rating, and this is how much your stockholders are paying for you to be walking around for the bragging rights of being, hey, we're a AAA rated company. There's nothing glorious about having a AAA rating for the sake of having a AAA rating. So you have to think about the cost you sometimes impose on companies when you put in a rating constraint that's absolutely unrealistic. So that's the second question. What if something goes wrong? Let's turn to the third question. What if instead of buying back stock or paying a dividend, I wanted to take investments instead? Like what? Build a Shanghai theme park, make more movies. Would my optimal debt ratio be different if instead of buying back stock I took projects? Do you think it would be? The optimal we came up with was 40%, but that assumed buying back shares with. Do you think my optimal debt ratio would be different? It really depends on what you plan to do with the money. If you plan to stay in the existing businesses you're in and just scale up, more theme parks, more movies, more broadcasting, more ESPN, then the optimal debt ratio is also going to scale up with you, because what's happening is your cash flows presumably will get larger if you get to be a bigger company. But what if you wanted to borrow this money to buy Twitter? Yeah, the $39 billion, you could buy Twitter, maybe even Tesla. Do you think your optimal should be changed then? If if I ask you to describe Twitter as a company, high positive cash flow company or high negative cash flow company? So basically you're buying a company with negative cash flows. High risk or low risk? It's a high risk negative cash flow company. Take it through to its logical limit. If you go into a business that's negative cash flows and high risk, what should happen to your optimal? It's going to go down. You can't afford to borrow as much money. So how would I find out an exact answer? You'd have to put in Twitter into your financials. So add the operating loss of Twitter, because they don't have a profit. So your operating income as a combined company will actually now get smaller. You now have more risk. So your ratings are going to drop much more quickly than they did. And you start borrowing money, you're going to see very quickly that your optimal is now going to become 25% rather than 40%. Never give a blank check to managers where you say, you have debt capacity, go do whatever you want, because they will do whatever they want. You have to be specific about what that debt capacity is used for before you decide whether in fact it will carry. So that basically kind of reviews the three questions. Why should we do it? If you do it, your value will increase by about 19.6 billion. And if you buy back shares at a fair price, your stock price will go from 67.71 to 78.61. That's almost $11 increase in stock price. What if something goes wrong? There's enough buffer here that I think you can borrow money and get away with it even if you have a bad year. And I've given you a single A rating at a 40% debt ratio, which is not a bad rating. Can we take investments? Sure, as long as you decide to just scale up your existing businesses. So what I'd like to do is use this approach now to take my other companies, and I won't go through them in the level of detail that I did for Disney because it's kind of wasteful. You kind of get it in terms of what I'm going to do. But with each of these companies, I'm going to talk about specifically what aspect of this company gave me trouble or gave me pause when I did the optimal debt ratio. First, I took Vale. I did exactly what I did for Disney, and I looked at the cost of capital. So if you look at the minimum cost of capital, the cost of capital for Vale is minimized at a 30% debt ratio. Their actual debt ratio was 39% when I did this in 2013. And I'm going to make a confession. In 2013, when I did the normalization, I was assuming that iron ore prices would revert back to, because they were already down, I assumed they would revert back, and I said if they revert back to what they were 2004 to 2013, the optimal debt ratio for Vale would be 50%. So if you assume that iron ore prices are going to bounce back, the 39% you're going to say it's okay, everything's going to be okay, you're going to bounce back. And herein lies what happens when you get big structural shifts. When I did that 2004 to 2013 average, the average iron ore price I got was $80 per ton. But you know why it was so high? The historic average for iron ore prices is closer to $25 to $30. You take a 100-year average, you adjust for inflation, it's $25 to $30. You take 2004 to 2013, you get $80. And the reason is China. I told you it works pretty much every single time. China. And what we've discovered in the last 3 years is maybe that infrastructure boom in China that caused iron ore prices to rise. We've been in Shanghai. You look at all that construction. I mean, that's in fact the biggest reason for the commodity price boom over the last decade. You scale that down. You know what the optimal debt ratio for Vale looks like right now? It's 30% in 2013 iron ore prices, but those were $65. Now iron ore prices are down to 35 to 40. The optimal debt ratio for Vale is now down to 10%. You know what's happened to its actual debt ratio? They actually haven't borrowed much more. But how do we compute debt ratios? We use market values, right? The market value of equity for Vale has collapsed, so its actual debt ratio is now 60%. Houston, we have a problem. We'll come back and deal with it. This is a huge problem. Basically, you have a 60% actual debt ratio, 10% optimal. Vale has become a hugely over-levered company. And I think part of it is not their fault, but part of it, I think, is their fault. And we'll come and kind of divvy up responsibility as we go along. So if you're working with a commodity company, don't be surprised if you see this for your company, that your actual debt ratio is higher than the optimal. Then I took Baidu. And I did the optimal debt ratio for Baidu. And the optimal debt ratio for Baidu is only 10%. Yes?
So for international companies,
Yeah.
is taking the bond rating associated to a specific interest rate, like an equity?
And the question was for Vale, for instance, I took the bond rating and I came up with a default spread. And because I'm doing everything in dollar terms, I added that. And that's going to underestimate my cost of debt for Vale, right? Why? Because that's what a US company would have. So you know what else I add for Vale when I do the cost of debt? I take the risk-free rate in US dollars. I come up with the default spread based on the rating. But then I also add the Brazilian country spread on top. So what you're going to see in the Vale cost of debt is a consistently higher cost of debt at every debt ratio because the country risk kicks in, which pushes down the optimal for emerging market companies because they now have to bear that burden. And if you take a company in Venezuela or Argentina, I've actually done a few optimals in the last few months. None of them can afford to have more than 10% debt, simply because the cost of debt is pushed up by that country risk factor. So it's very easy to build into the spreadsheet, and in the spreadsheet it's also actually built in. It asks you what country the company is in and takes the default spread for that country and adds that on to the cost of debt at every single debt ratio. For Baidu, the optimal debt ratio was 10%. 10%. It's a money-making company. Saying, how come it can't borrow more money? Because it's a growing company. You're saying, so what? Remember, the market value of equity reflects growth assets. So market value of equity for a growing company, whether it's a Facebook or a Google or, is going to be high, but much of those assets are not even on the ground yet. So when I compute the optimal debt ratio of 10%, it reflects the fact that 10% of the market value is still a big number, and if I go past 10%, I'm going to very quickly start getting into really serious trouble. Remember I said some of your companies, the optimal debt ratio will be 0%. If you have a young, high-growth company, even if it's making money now, and that's a requirement I put in, so if it's not making money now, don't even start the spreadsheet because I'll save you the trouble. What's your optimal debt ratio for a company with an operating loss? Don't borrow money. You can save that. So hopefully you followed at least that instruction of making. But if you have a growth company with operating income, don't be surprised to end up with a low optimal debt ratio simply because you can't afford to borrow money on growth assets. I don't know whether I missed Tata Motors. So I did the optimal debt ratio for Tata Motors, and there the optimal was actually about 20% debt. So for Tata Motors, I did the same thing as I did for Vale. I added the Indian country default spread to their cost of debt. 20%. Their actual debt ratio is almost 30%. And here I think there is a story. I actually did this for 4 Tata companies: Tata Motors, Tata Steel, Tata Chemicals, and Tata Consulting Services. They're all part of the Tata Group. Tata Motors, Tata Steel, and Tata Chemicals all came out as over-levered. They had too much debt. And I did Tata Consulting Services, which is close to India's largest market cap company. It was significantly under-levered. So it looks like 3 of the 4 companies are over-levered. 1 is significantly under-levered. Remember we talked about how family groups can affect leverage? I don't know whether this is happening, but I'll guess. Here's what's happening. If you're Tata Motors, you go into a Mumbai bank to borrow money. They look at your operating income and say, that's a lot of debt for you. But then what do they also look at? They look at the fact that you're a Tata company and say, if you get into trouble, the family group is not going to let you go under. There's this implicit borrowing. So in a sense, it's almost like Tata Motors, Tata Steel, and Tata Chemicals are borrowing not against their own debt capacities, but against Tata Consulting Services debt capacity. You know who this is unfair to? Tata Consulting Service stockholders, because they're, in a sense, who are they subsidizing? They're subsidizing Tata Motors buying Jaguar Land Rover. They're subsidizing Tata Steel buying Cora Steel. They're subsidizing Tata Tea by buying Tetley Tea. Basically, they're subsidizing all these acquisitions indirectly. What can you do about it? Nothing. Just build it into your price. Nothing you can do about it. You can sit there and say, this is the optimal debt ratio for Tata Consulting Services. It doesn't matter. You're not going to be in the driver's seat. And that's why corporate governance kind of drives the way you do this part of the analysis. So finally, I turned to Bookscape. Private business, right? But even private businesses have to decide whether they're borrowing too much money. There's one little problem I ran into, because if you remember how I started the Disney analysis, to compute what a 10% debt ratio was, I took the market value of equity plus the market value of debt to come up with the value of the firm. Now do you see why this is going to be an issue with a private company? There's no market equity. I can estimate a market debt, but there's no market equity. So I had to cheat. With Bookscape, here's what I did. I took their net income, which was given, with 1.575 million was their net income. I took a price earnings ratio, which is almost something I never use in evaluation, but since I just want a rough estimate of value here, a price earnings ratio of publicly traded book companies. Remember the companies I got the betas from? 20 times earnings. I multiplied the net income by that price earnings ratio. I came up with an estimated market value of equity. That's what I'm going to use as if it were the market value of equity. It's cheating, but with private companies, you actually have no choice. You have to use a multiple to get started, and what you get is an estimated value for the company. Then I did exactly what I did for Disney, and there's my cost of capital. My cost of capital for Bookscape is minimized at about 30% debt. The debt ratio I used for Bookscape was 27.81%. I'm not going to say it's under-levered. That's too close to even make that call. Because when I say 30% optimal, I'm just saying it's around 30%. In the case of Bookscape, at least, my conclusion is you're okay. You're fairly, no, you have just enough debt. And I'll make one final difference between public companies and private companies. When a public company has too little debt, I will push. Push in what sense? Too little debt, I'm going to ask you to borrow more money. And if you say you're uncomfortable, I'm going to ask you to take a couple of Zantac and go borrow the money anyway. Why? You're the CFO of a company. You can't say, debt makes me uncomfortable. If it makes you that uncomfortable, find a different job. If it's a private business owner who says, I don't want to borrow money, it makes me uncomfortable. So of course. I don't want you to drop dead and you're, because of, you're getting stress on your heart from borrowing too much money. There's a big difference in public and private companies. Private companies that choose to not borrow money, it's their money. Public companies would choose to not borrow money. It's their shareholders' money. They either have to explain to the shareholders why it's okay to not borrow money or expect to come under pressure to borrow more money. So that's a cost of capital approach, and it's an approach that's been around a long time. I've taken the approach. It's been around in textbooks, and I've essentially tried to make it more practical by being able to estimate the cost of equity and the cost of debt. But having worked with the cost of capital approach for about 30 years, I can tell you what its weaknesses are. The first is, it is a static approach. You see what I mean by static? I took last year's operating income. I took interest rates as they are today, risk premiums as they are today, and estimated an optimal debt ratio today. That's the first mistake. The second is, when I went from 0% debt to 90% debt for Disney, my operating income stayed at $10,032 million as I went from, you're saying, so what? My rating went from AAA to single C, but my operating income never changed, right? Why is it unrealistic? Because we talked about indirect bankruptcy costs. If my rating drops, I should expect my operating income to actually get lower at a BBB and a BB. Why? Because there will be people who will not buy my product. So that's the second potential problem. The third is, I am getting my cost of equity from a levered beta and a cost of debt from a synthetic rating. To the extent that those processes are screwed up, my cost of equity and cost of debt are going to be off. So let's actually look at a way in which we can bring this in. And this is something I've built into the spreadsheet I'm going to send you, and you're going to see it show up as one of the options. There are two things I'm going to do. First is, I'm going to let your operating income, instead of being a fixed number, be a function of your ratings. So as your ratings drop, I'm going to say, if this happens to your rating, your operating income will drop by 3%, 5%, 10%, 15%. So I'm going to bring in indirect bankruptcy costs. The second is, if I wanted to, remember those Monte Carlo simulations I talked about where you could let everything be a distribution? I could do that here as well. I could make your operating income be a distribution. I could make risk premiums be a distribution and see what percentage of the time you get into trouble. So let's take that first thing and try it for Disney. What I did for Disney is I took each rating and I said, what might happen to Disney's operating income if the rating dropped? So AAA all the way down to single A and even A minus, I didn't see any effect on Disney's operating income. Nobody's going to stop going to Disney theme parks because it's an A-rated company. Suppliers are not going to cut off supplies because it's an A-rated company. So until A minus, I was okay. When they got to BBB, I actually lowered the operating income by 5%. Why? Because BBB, you're getting a little dangerously close to that investment grade status, so people might start to wonder, the suppliers, the employee effect. As you drop below BBB, every ratings drop comes with this added layer of there's a cost. You're saying, how do you come up with the 5, 10? I could be truthful and say I made it up, but I'm going to lie slightly. I did look at what happened to the operating income of companies that got downgraded. So what I did was I took you can take a subsample of companies of the last 25 years that have been downgraded, and I looked at the operating income the year after they got downgraded. It's kind of a sloppy thing to do because there are other things going on as well. But on average, this is how much the operating income seemed to drop the year after a downgrade. So I've built that into the spreadsheet. So now two things are going to change. As my debt ratio changes, my interest expense is going to go up. So as my debt ratio changes, I also have to check to see if my rating is dropping, and if it's dropping, my operating income is going to decrease. My objective can no longer be just minimizing the cost of capital, and here's why. Because I minimized the cost of capital. That worked because I kept the numerator fixed. Here the numerator is also changing, so I've got to look at what debt ratio is going to maximize my value. So I've got to go back to the original objective because I can't use the shortcut anymore. You see why that is? Because in the cost of capital approach, when I minimize the cost of capital approach, I assume the numerator stays the same no matter what my debt ratio is. And here since the income is changing, I have to look to see where the value is maximized. And you know what? the value is still maximized at 40%. But notice what happens when I go to from 40 to 50%. My value just completely implodes on itself. Another red light saying, hey, maybe you don't want to go all the way to 40% because if things go wrong, you could very quickly get into that debt spiral. But at least based on the enhanced cost of capital approach, I'm still okay till 172 billion. Why my rating is still single A? But as my rating starts to drop, you see that double layered impact kick in. And once that kicks in, your value is going to just kind of go into nothing. So the enhanced cost of capital approach, that's all we're doing, is we're bringing in the costs of bankruptcy into the operating income, the indirect costs. Any questions on the enhanced cost of capital approach? So let's close today's session by talking about whether we can actually do this for banks. Can a bank be over-levered? I read news stories all the time. Bankers, I think actually that's a wrong word to use. Banks are not over-levered. They're under-equitied. Sounds like you're playing with words. But the reason I say that is for a bank, debt is really not a source of capital. It's a source of raw material. In what sense? You borrow money at 4%, you lend it out. That's how you're supposed to make money. So debt to a bank has a very different meaning, and it also is something you can't really, so you can't say the optimal debt ratio for a bank is 80% or 70% or 50%. That's why computing cost of capital for a bank is a waste of time, because you can compute a cost of equity, but there is really no cost of capital for a bank. It's all equity focused. So when banks talk about capital, it's almost always equity capital. So you can ask, does my bank have enough equity? So if I ask that question about Deutsche right now, what's the answer? Have any of you been reading the news stories about Deutsche? Some horrible news stories. Clearly they have too little equity. Relative to what? Relative to what they need to have. You're saying, who comes up with that number? Well, it's partly regulation driven, right? Because you have regulatory capital requirements, and partly driven by the fact that you have risk in your businesses that require you to have equity. So with banks, when we talk about financial service, when we talk about do you have the right financial mix, we're really asking, do you have enough equity? So I'm going to give you a very simple way to actually bring this into process. Let's take a very simple bank, an old-fashioned bank that essentially just makes loans. It makes money off those loans. So this bank right now has 100 million in loans outstanding. So these are the loans it's made, and its book equity is 6 million. Let's assume, again, this is not a bad assumption, that book equity and regulatory equity are the same number. So right now its regulatory equity ratio is 6%, and there's 100 million in loans outstanding. But it's a growing bank. Next year it expects its loan base to grow by 50%, from 100 to 150 million. But some of these loans are going to be in riskier businesses. They're lending to riskier people, so they want to bring their regulatory equity ratio from 6% to 7%. So let's see where we are. Right now you have 6 million in equity, 100 million in loans. Next year you're going to have 150 million in loans, and you want to have 7% of that 150 million, or 10.5 million in equity. So you got your target, right? You right now have 6 million, you need to be at 10.5 million. What's the nicest way to make up the difference as a bank? Is you make money, you have net income, whatever you don't pay out as dividends becomes retained earnings, which pushes up your book equity. So if you're that profitable that you can make 4.5 million in retained earnings, your problem goes away. Almost no bank is going to be able to do that, right? So let's say that your retained earnings can be $1.5 million. Why? Because you paid $1 million in dividends. You have $2.5 million in net income, but you paid $1 million in dividends. If you're $4.5 million in the hole, what's the first thing you want to do? You want to stop paying dividends. We'll talk about why banks will almost never do that. If you do that, then you end up with $2.5 million retained earnings. You're still $2 million short. You have to go out and raise $2 million in new equity. For banks, this is as simple as it gets. This is the way you think about financing, is you think about what you have as regulatory capital, what you need to have. Then you look at the variables that are under your control. How much do I pay in dividends? What did I make in net income? And once you get past that, you have to raise fresh equity to make up the difference. That's Deutsche's problem. Deutsche's problem is that regulatory capital is now well below what it needs to be. It didn't used to be that. 4 years ago, the regulatory capital was actually higher than what it needed to be. So what happened in those 4 years? That, and when JP Morgan had that big whale problem, and they had to write off, I don't know, 2 billion, 3 billion, whatever they wrote off, where does it come out of? It comes out of your regulatory equity. So every time you have a big write-off of something bad that you did in the past, your regulatory equity is going to drop. It's going to mean that you got to make up the difference. That's been at the core of the bank's problems for the last 6 years. Is they're actually making money, but every 2 years they hit you with this, oh, we didn't see this coming, but there's a $6 billion loss we have to take on that mortgage loan investment we made 5 years ago. Every time you do that, your regulatory equity drops back. So that becomes the process by which you think about a financial service firm. So I'll close with this page. This was from a better time when Deutsche actually looked good. Its regulatory capital ratio, when I looked at it, was about 15.13%. I did assume that Deutsche would want to increase its regulatory capital ratio because forces were already in play that was going to happen. So on this page, basically all I've done is focused on forecasting what the regulatory capital will have to be every year for the next 5 years. That then drives whether I need to go out, borrow more money, raise more equity, or pay more dividends. So we'll stop with that. We'll start back up with the last approach to optimal capital structure next session, which is the adjusted present value approach.
Sorry, I was trying to over this morning, and while you're like running across the street. And so I started my project really late, but delved into it this weekend. And one of the things I came across on your other instruction was that if you don't have a 10-page description page or something in Bloomberg, okay, because I'm doing Nintendo and I'm doing the Japanese. As long as I'm doing it in the Japanese figure, it should be fine.
I have a question. So I'm going to be in Dubai in the summer where the tax rate is zero. So is the debt ratio a lot lower optimal for companies? And then would LBOs be less effective in that area? They won't work. They won't work? Right, that's it. Right. Like,
What does this do with the slide on the company and does it give you
Well, in the initial analysis, the 40 billion was used to buy back stock, right? So if they said they wanted to do something else, the 40 billion, at least in the 2013 plans, was to build a Shanghai theme park, to extend the California Adventure theme park. It was mostly investments in their existing businesses. But today, they could say, I want the 40 billion because I want to buy a nice technology company, right? Yahoo Passive Company said, I'd like to buy it. If you said that, then I have to redo the optimal because I need to know what you're buying. Is it riskier or safer? Is it high cash flow or low cash flow? Because those will then change my optimal debt ratio. But in a sense, you have the capacity to borrow 40 billion. You then as a management have to tell me whether you want to use that to reduce your equity or do something with the company. Yes. I would love some help, but I don't do any traditional. I'm a dabbler. So what I do is I pick something that interests me, I lose interest in 2 weeks. So if you want to dabble with me, relax and pick something you're interested in, and I'll give you 4 or 5 topics in it which I think are, and I'll work with you if you're interested.
I'll email you.
Okay. Take care.
Is there an indirect benefit for a company that's AAA in the same way there's an indirect bankruptcy concern?
Not in most businesses. In financial services, there might be some direct benefit because there are certain kinds of financial businesses you cannot get into without a AAA rating. Repurchase agreements. So financial services is the only segment where there's a subset where being AAA rated gives you a special benefit in almost every other business. AAA versus single B clearly makes a difference. AAA versus double A. Who cares, right? Yeah.
Tax shield and the after-tax cost of debt with the new tax rate.
Because you don't have the tax benefits to claim. If I just multiply the cost of debt by 1 minus 0.361, I'm assuming that every dollar of interest expenses saves me 36.1 cents in taxes. But if I don't have the income, I'm not going to get that benefit.
Okay.
So that's what those lower tax rates are, is I'm capturing what I'm actually going to get in tax benefits because my interest expenses now exceed my operating income.
Okay, and you're saying you're never going to carry that forward, or how?
Well, I am, but I can't let you borrow on the presumption that the carried forward, because your income will have to rise over time to cover your interest expense. It's one thing if you had a bad year and your income falls below interest expense, I'm going to say, you know what, you're going to bounce back because you just had a bad year. But this isn't a bad year. I'm taking a good year for Disney. I'm borrowing up to the hilt on that good year. And say, trust me, income will grow further to cover it. If it does, I'll give you the benefit, but I'm not going to let you borrow money on the expectation that growth will bail you out.
I see.
Yes?
And you were saying that for Argentina, the debt level, the threshold was
The
very
cost,
low.
if you're carrying the burden of country risk in your cost of debt,
Yes.
it's going to push up your cost of debt, right? So effectively, it means that
Yeah.
you could have the same interest